Okay, sorry for the delay. And theoretically, this lecture is being recorded, so you can go back and look at it later. But theoretically, every lecture is being recorded. But half the time the system doesn't seem to work. So if you want to listen to this again, there'll be a link on the Study Smart page, maybe, to watch it again. Where we got to the other day, or where we're picking up from, is this hard example. A hard financial maths example. Why is it hard? It's got two things in it above and beyond the simple finding of present values. We've got cash flows coming at periods 1, 3, 5, 7, 9, 11, 13, 15, 17, 19. So 3, 4, 5, 6, 7, 8, 9. There's a 10-period annuity. Now, finding the present value of a 10-period annuity should be relatively straightforward. You either use tables or you use the formula. The trick here is, well, there's two tricks. One, the payments come every 2 periods. So that's a trick. There's 3 tricks, I suppose. The payments come every 2 periods rather than every single period. And the first payment is at period 1, not period 2. And so it's not an ordinary annuity, so we've got a starting point problem. We've got the fact that they're every 2 periods problem, and we've got the fact that we've got an APR problem. To find the present value of cash flows, we need an effective rate. If we're going to use the annuity formula, and it's every second month, we need the effective rate for where n is 2 months. So a lot of different ways of solving this problem, but the way I'd approach it is to say, firstly, let's get the interest rate correct. So we've got an APR of 10% with quarterly compounding. Quarterly compounding is every 3 months. We want an interest rate for every 2 months. We can't just take 2/3 of it because we can't add and subtract interest rates because of the compounding effect. So let's see if I can get this to work. Step 1, calculate the EAR. If you think of each step in this process as being, if this is a test question or an exam question, you think of each step as being worth marks. You don't have to get, if this was the hardest question on a test paper, you don't have to get 100%, obviously. To get a high distinction, you only have to get 80%, and probably getting 50% on a hard question is pretty good. So step 1, use the EAR formula. 1 plus the APR divided by K, quarterly compounding 4 times a year, to the power of K minus 1. And you do this and you write that, and then you keep that number in your calculator so that if you were to write it down as 0.1038, then you'd end up with a slight different answer to me because of rounding. But I just do the whole thing in the calculator. So that's the effective annual rate. Then we want the rate for every second month, every 2-month period. So we use the formula 1 plus r to the power of n, where n is the fraction of the year. So the 2-monthly rate is 1 plus the EAR to the power of a 6th. So got the annual rate, come back to the 2-month rate by not dividing by 6, but by taking the 6th root and subtracting 1. Now, if you're smart, or if you're quick on the uptake, you'll have realised that what I did here was take 0.1 divided by 4 to the 4th, and then take the 6th root of that. Well, I could have done those two things in one step by saying it's 2.5% per 3 months, and I want the rate for 2 months. I don't take 2/3 of it, I take it to the power of 2/3 minus 1. So 1.025, the third root, will give me the monthly rate, and compounding it, squaring it, will give me the 2 monthly rate. And that's just putting those two together in one step. So 1 plus 0.025 to the power of 4 to the power of a sixth. Multiply the indices together. 4 times 1 over 6 is 2/3. So now I've got the rate, I can find the present value of the annuity. What point in time will I pick? Well, I've decided to value this at month 1. So I'm going to do it in month $1. So at month 1, I get $10, and then at month 1 starts a 9-period annuity. Because after month 1, every 2 months, there's a payment of $100. So if I work out the present value at month equals 1, I've got $10 in month $1, then $10 per period, annuity factor, for 9 periods at this rate K, which is the 2 monthly rate. So call this rate here K. Stick that into the annuity formula with N equals 9, multiply by $10 and add $10, and I've got the present value at month equals 1. Then I want the net present value, so I need to break this back to time period 0. So at time period 0, I need to discount 1 month, which would be 1 plus the EAR to the power of a 12th, or it would be this rate halved to the power of a half. But doesn't matter, or whatever. And then last step, I need to take into account the cost of $80. And I get an NPV of $12.20. Yeah, as I say, you could have done that other ways and ended up with this. Uses okay. 10 is that plus 10. You've got to divide that by 1.0826 as well. That's the first month. And this is a 9-period annuity. But when you use the formula, what does it give you? It gives you the value at month 1. Yeah, that's that. But what about this part? Yeah, that part is at that's in month $1. That first payment comes at time 3.
So we should also divide.
We also need to divide that by that.
So this is also correct.
Yeah, that's correct. Well, if you did that, then you'd end up with exactly.
90%.
Yeah, I'll give you 9 out of 10. So it's just the deferred part of the annuity that you got wrong. Yeah. And if you had, just remember, if you had absolutely no idea how to do that question, you still should have been able to work out an EAR. You should have been able to work out that there's a 9-period annuity. And even if you got all the rates wrong, there's no reason not to get chunks of the question right. But put it all together, that's a hard question. because it involves straightforward calculations and 3 tricky bits. And you got 2 of the tricky bits right, but one of them wrong. One of them missed. So go back and you can always go back and have another look at that. New topic. We're a little bit, don't know if we're behind or not. This is a more straightforward topic, really, right? So for the next 2 weeks, this week bonds, next week shares, we're going to look at valuation of financial assets. And if you remember from week 1, definition of a financial asset is a claim against another economic entity to a series of cash flows over time. Next week, equity, and this week, debt. The good thing about valuing debt is that we know what the cash flows are. The terms of the debt agreement means you know there's nothing indeterminate about the cash flows. If you borrow $100,000 at 5% interest, you're going to be paying 5% interest and you're going to owe $100,000. So you know what the cash flows are. So to find the present value is really not any different to what we've done, what we did in, this is chapter 6, isn't it? So chapter 6 isn't that different to chapter 5 because we know what the cash flows are. If we know what the cash flows are and we know what the discount rate is, we can find the present value. And that's what valuing bonds is. All we're doing is finding the present value of the cash flows. So, the jargon, if you get on top of the jargon, we need to know what coupon bonds are, what zero coupon bonds are, and how to understand what the cash flows are. And if we can do that, then we should be able to value them. We need to understand these different yields, yield to maturity and running yield, and what impact they have, which is bigger than discount rate, which is less. You need to get on top of that. Given some information, coupon bonds either sell at a premium or at a discount. Well, that's not too hard to know what that means. A premium means it's more than the face value. Discount is it's less than the face value. What happens to bond prices when interest rates change? So a bond is a generic debt instrument. The Australian government at the moment wants to borrow money. They borrow money by issuing bonds. Let's say they issue a bond that says $1,000 face value, which means, and they want to borrow it over 10 years. So if you own that, if you buy that bond from them now, in 10 years' time, they'll give you $1,000. And between now and then, they'll pay you an interest rate. Let's say they'll pay you 5%. So each year you're going to get $50 worth of interest, and in 10 years you're going to get $1,000 back. Right? And you think, well, that's you make that investment. That's because that's what you're living on. It's better than bank interest, and it's a safe investment because it's a government bond. So you're happy with that. But interest rates change. If interest rates go down next year, and next year the interest rate is 3%, and they issue bonds paying only $30 a year, your $50 a year claim is good. So everybody would like to have your bond that pays 50 rather than the new bond that pays 30. So people will want to buy it off you for more than you paid for it. And you'll be a winner. So when you hold fixed interest securities, either as a borrower or a lender, you can, as interest rates change, the value changes. Because the value is the present value of the cash flows. The cash flows are fixed. If the interest rate changes, the value changes. You can win or you can lose. And if you don't want to win or lose, you can hedge, which is the whole point about using interest rate options and futures, which we don't do in this course, but we do in later courses in the finance degree, learn how to hedge against the risk, because you face risk. If interest rates change, you might go broke or you might double your money. which leads us to the concept of duration, which we don't calculate but we talk about. And then a little bit about default risk and creditworthiness. Basically, because we start off, as is usual, we start off assuming everything's risk-free and then relax that assumption and allow for risk. So let's define what a bond is. A bond is a generic term. It means a debt instrument. It's sold by the borrower to the lender. It promises a periodic interest payment and repayment of principal at maturity. Right? So a bond is, if you like, it doesn't have to be a piece of paper. It can be an electronic piece of paper. But it's a piece of paper it's an IOU. If people borrow money, and bonds covers a lot of terminology. Bonds is more the American term. In accounting, in the accounting course, did you ever talk about debentures? Okay. What are debentures? Debentures are a bond. Yeah. A debenture is a type of bond. Usually, a debenture is more the Australia. In Australia, we have debentures, which are secured bonds. They're bonds with some form of security provided by the company, and unsecured notes. Unsecured notes are the same as debentures, except they're unsecured. But they're both bonds. So bond covers and bond is more American, debenture is more Australian. They don't talk about debentures really in America. Right? It's just more the British system. So if you're from Singapore, you probably have debentures. If you're more influenced by the American stock market, you have bonds. But it's the same thing. Debenture is a type of bond. So bond is the generic whatever. And we have some form of certificate which states the terms of the bond. So for every bond or debenture or unsecured note or promissory note or whatever you want to call it, for every debt instrument, we need to know the face value. FV, the face value. You could also call that FV for future value, because that's the principal to be repaid in N years' time. It's the future value of the bond. That if the government issues $1,000 bonds, the face value is $1,000, and the holder of the bond at maturity will get the face value. The maturity date is when the face value will be repaid. It might be short term, it might be medium term, it might be long term. It might even be forever. So some countries, if you have issued bonds that are perpetuities, they're never going to be repaid. Called consol bonds. The interest will always be paid each year, but the principal will never be repaid. So if you're an owner of a consol bond now, the reason you've got it is you inherited from mum, who inherited it from granddad, who inherited it from someone who inherited it. It's never gone away. They're not that common as perpetuities. So the maturity date is when the face value is repaid. The term is the time remaining until that maturity date. So if they're issued now and the maturity date is in 10 years, there's 10 years to go. But the same bond next year will have a term of 9 years. Right? Because our bonds most of them are negotiable, which means there's a secondary market. You buy the bond from the government, but you don't have to hold it for 10 years. You could sell it to someone else. Bonds are listed on the bond market, on the stock exchange. Government bonds are listed, private company bonds, if they want to. If they pay the listing fee, then they're listed. So you buy BHP's debentures, and because you've got surplus money now, and they're 20-year debentures, any time in the next 20 years you can sell them, as long as there's somebody who wants to buy. So you can always sell at the value of the bond. So it's a liquid investment, mainly. But there can be private bonds that are non-negotiable, which maybe you can't sell and you have to hold. So it all depends upon the terms of the bond. The coupon, we call the promised interest payments the coupon. And the coupon rate is the amount of each coupon payment. Note, for historical reasons, it's an APR. So that 10% coupon rate, 10% of $1,000, $100, that's an APR. So the coupon payment is the coupon rate times the face value. 10% of $1,000 is $100, or 5% is $50. And then depends how many coupon payments are made per year. A lot of coupons will pay interest. Usually it's either annual or semi-annual. So you get the interest every 6 months or every year. 6 months is more common, but textbook examples, it's more common to do it on an annual basis because the calculation's easier. Because if you start doing things on a 6-month basis, then you've got problems with converting APRs to EARs and all those extra issues. But the coupon payment is the coupon rate times the face value over the number of payments. Why do you think it's called a coupon? What's what has anyone got any coupons in their pocket? What's a coupon? What? Yeah, no, but what in general terms, what's a coupon? A discount. So if you had a little tear-off thing from the football, I don't know, tear off from the football budget, you can go to McDonald's and get 2 burgers for the price of 1. And you hand over the coupon and you get some value for it. Or you can buy your detergent or your meat cheaper, because you collect coupons. Or you get your cup of coffee cheaper, right? Little tear-off coupons. So why do you think they're called coupons? In the old days, yet again, this is all pre-computer. Bonds have been around for a long time. So you issued a 10-year bond. So the 10-year bond would have 10 coupons attached to the bottom of it. And each year, you tear off one of the little coupons. Just the same way if somebody advertises a textbook to sell and they've got their phone number on it. You tear off one of the coupons and then what do you do with it? Then you take it to the bank, whoever their sponsoring bank is, give them the coupon and they give you the money. Of course, you don't do that nowadays because you're registered electronically as the owner and they've got your bank details, so the money just gets deposited in your bank account. But 100 years ago, you would go and tear off the coupon and go to the bank and they'd count out the coins and, you put it in your little money bag and off you'd go. So the word hasn't changed. It's still called a coupon. Now, these bonds and these, we haven't talked about this before, but most financial assets, we talked about them being liquid, and liquidity is the ability to sell an asset for close to the price you could buy it for. So you could, if you buy a bond today and you find tomorrow you get this massive tax bill, and you think, and you've got to pay your taxes, and you think, I've got to sell the bond. Well, if the market's liquid, you should get, apart from small transaction costs, you should be able to sell it for more or less the same as you paid for it, because there'll be somebody else who wants to buy it from you. So we have the ASX, the Australian Stock Exchange, is an auction market. Has anybody ever looked at the ASX web page? If you look at the asx.com.au and over the years get used to looking at the ASX web page, what sort of information about companies is there, track the trading history, pick a company and follow what happens to its share price, learn how to do all the different, a lot of tools on the web page. You can do graphs, you can track it against inflation, you can track different currencies, track different types of shares. There's a lot of stuff you can do there. But what you'll see in an auction market is you'll see a buy quote, which is somebody's offer to buy, and a sell quote, which is an offer to sell. And of course, the sell quote is going to be greater than the buy quote, because you would buy at somebody's sell and sell at somebody's buy. And it's not possible, it shouldn't be possible at the same, see, if the buy was greater than the sell, then you could buy at $1 and sell at $1.10 at the same time, and you'd be making money. But so normally, let's say if the buy quote is $1, the sell quote would be what? Do you think? For shares, a share or a bond. The buy quote is $1, the sell quote's going to be bigger. How much bigger? Yeah, well, do you think that these two would be close? The difference between the two is the cost of a round-trip transaction. So if you buy it for $1 and you've made a mistake, and you if you buy it for $1, this is the dollar, well, and you immediately want to sell it, should you get close to $1? Yeah. So there'll only be a couple of cents different. So if buy is $1, sell is $1.02. Right? So you can buy them at $1.02 and sell them at $1. The 2 cents difference means that there's no arbitrage profit. You can't buy and sell at the same time and make money. And it's just a small difference in transaction costs. And we call these on the ASX buy and sell quotes. On American stock markets, they're called bids and asks. The bid is the buy quote. You can sell at it. So the bid is the buy quote, and the ask is the sell quote. So have you heard of bid-ask spreads? Right, well, the bid-ask spread is the difference between the ask and the bid. So say 1 or 2%, a few cents difference. And that's a transaction cost. If you were to buy and sell at the same point in time, if you were to buy and sell at the same point in time, you would lose the bid-ask spread. And that bid-ask spread becomes quite important as a measure of uncertainty. So, well, not in this course, but when you study investments, we'll see that the size of the bid-ask spread conveys information. So the less that is known about the company, the more information asymmetry there is, the bigger the bid-ask spread. Very well-known large blue-chip industrials, BHP, Westpac, have small bid-ask spreads because there's a lot of analysts tracking them and there's a lot of information known about them. And that's just an aside, really. Normally I speak about that week 1, but it fits better in here. Another point to make is that taxes impact on interest. Interest in Australia, the interest you earn is taxable, and the interest you pay as a business is tax deductible. So we talk about before and after tax costs of interest. So if the tax rate, T here's the tax rate, if T is 30% and R is 10%, you can borrow and you invest at 10%, but you've got to pay 30% taxes, then your after-tax rate is only 70%, it's 7%. Same way if you're borrowing at 10%, but you're paying a 30% tax rate, then your after-tax cost of debt is also only 7%. So, we just need to be aware of that. So we said we need to be value debt. Let's start with the simplest form of debt instrument. The simplest form is called a zero coupon bond. Why is it called a zero coupon bond? Because it has zero coupons. It doesn't pay periodic interest payments. Because it doesn't pay any interest, then because of the time value of money, it's going to sell at a discount. So they're called pure discount bonds. Let's say you have a 1-year risk-free zero coupon bond, 100,000 face value. And this is the government's borrowing and it's selling them for that much. So if you were to buy this bond, it would cost you that much. Were you to hold it to maturity, you'd receive that much. So, although the bond pays no interest per se, because it's a zero coupon bond, if you like, the difference between the purchase price and the face value is the interest payment that you get, is the profit that you earn. And you're going to be taxed on that. That's a tax issue. But that, for tax purposes, that's the same as interest. What's the yield on that bond? What rate of return have you earned by investing in that bond? Can you do the calculation? Invest that much, return that much. So one way of doing it would be, say, you make a profit of $3,381.64, and that as a percentage of your investment is what? 3.5%. So, or that times that divided by that is 1.035. So you're making a 3.5% return. Is that good or bad? Depends, exactly, depends what. In today's market, it's a bit low, isn't it? It would be a good return in America. It would be a bad return in Australia, to a certain extent. So it depends upon the level of interest rates. How are we going to value these things? Well, we value them. The price of a zero coupon bond, the price or the value, is simply the present value of the future cash flow. So the future value divided by 1 plus the yield to n. So the discount rate, which is an effective rate, has to be an effective rate, is called the yield to maturity. It's the return earned from investing in the bond. So it's the discount rate that sets the present value of the promised bond payments equal to the current market price of the bond. So the yield to the maturity, future value divided by P to the 1 over N. In other words, for the zero coupon bond, 96,000 is the present value of 100,000 in 1 year's time at whatever the yield is. And as some of you worked out, that yield is 3.5%. So which comes first, the yield or the price? You're a bond investor, do you calculate that the EAR, the yield, should be 3.5%, and therefore that the bond price will be 96,618? Or do you just pick the number 96,618 out of the hat? Or is it a combination? Well, this 96,618 is set by supply and demand. The government wants to sell them. How much does the government want to sell them for? As close to $100,000 as possible. So the government wants to sell them for as much as possible. How much do you want to pay? As little as possible. So the government would like to borrow at 1% and you'd like to invest at 20%. What's a fair rate of return for the risk involved for the time period of invested? Supply and demand forces will fix the price at a yield of 3.5%, which is 96,618.36. So that's a 3.5% for 1 year. What about for more than 1 year? Well, suppose the following zero coupon bonds are trading at these prices. Note, the further into the future you go, the bigger the discount because of the time value of money. So to find the yields, that 1 year bond is a 3.5%. The 2 year bond has a yield to maturity of 4%. The 3 year bond has a yield to maturity of 4.5%. The 4 year bond has a yield to maturity of 4.75%. So the interest rates are getting bigger. Does that make sense? Does it make sense? If you're going to tie your money up for 1 year, you want 3.5%. If you're going to tie your money up for 2 years, you want 4%. That sort of makes sense. The longer that's called, if you like, that's the maturity risk approach. So the interest rates could be going upwards. This is known as the term structure of interest rates. The term structure is the relationship between the investment term and the interest rate. Because this is a complication, is that the interest rate can vary depending upon the investment horizon. So the risk is the same, it's still the same government bond, but if it's a 1 year bond, you want a different rate of return than if it's a 5 or a 10 year bond. And the yield curve is a graph of that term structure. Let's look at the term structure of risk-free US interest rates. November 2006, that's the blue line. The term structure was sloping down. In November 2008, the term structure was sloping up. A 1 year bond in November 2008 was yielding 0.6%. A 1 year bond in November 2006 was yielding 5%. What happened between 2006 and 2008 to change interest rates? Well, that was the global financial crisis, right? The bottom dropped out of a lot of markets. So in November 2006, short-term rates were higher than long-term rates. But in November 2008, short-term rates were much lower than long-term rates. And then there's a lot of, and we're not going, if in a monetary economics course, you might spend your whole time talking about the different theories underlying the term structure. If you could guess what the term structure was going to do, what would you be? Well, buying or selling bonds, and what would you become? Rich. If you could guess what interest rates were going to do, you'd become very, very, very rich. Which means you can't guess. You can guess, but you'll be, how often, if you guess, how often will you be right? On average, 50% of the time. Yeah. Because some people will guess up, some people will guess down. That's what drives the trades. But it's all based on expectations of what's going to happen in the future. So in November 2006, already markets were worried about what was going to happen long term. So interest rates are falling. I think there's going to be a recession. When we're in the recession, people think, well, interest rates are low now because there's a recession. But in 10 years' time, there probably won't be, so interest rates can be higher. That's expectations theory, there's liquidity risk theory, there's inflation-based theories, there's a whole lot of different theories, but won't worry too much about that. What that can tell you is that the shape of the yield curve is influenced by interest rate expectations. An inverted curve, downward sloping, an inverted curve indicates that interest rates are expected to decline in the future. Why? Because of an economic slowdown. So the inverted yield curve is interpreted as a negative forecast for economic growth. An upward sloping yield curve indicates that interest rates are expected to rise in the future. It doesn't mean they will. This is all about expected. They're expected to rise in the future. So as you come out of a recession, interest rates rise. If we were to look at this graph here, the size of the amount is the difference between the 1 year and the 10-year bond rate, I think. Yeah. So the difference between the 1 and the 10-year rate. So in November 2006, 1 was 5, 10 was 4.75, so there's a difference of about 0.25. But in November 2008, 1 was 0.6, 10 was 3.5, so that's a difference of about 3. And here, the 10-year is greater than the 1, that's 2008. So you look at 2008 on this graph, that's blue. The blue part is where the 10-year is greater than the 1 year. That's an upward sloping yield curve. So the blue is the upward sloping yield curve. The red is the downward sloping, the inverted, where the downward sloping, where the long-term rate is less than the short-term rate. And if you look at America as a forecast for recession, 1, 2, 3, 4, 5, 6, 7. The last 7 recessions in America have been preceded by a period when the yield curve was inverted. Not always straight away, and not necessarily, and sometimes at the same time. So all that's saying is that investors are rational. And if there's going to be a recession, would you rather, in a recession, Would you rather hold risk-free government bonds or risky shares? Government bonds. You'd rather hold risk-free government bonds. So if you're going to hold risk-free government bonds, that pushes the price up. If the price goes up, what's happening to the yield? It's going to go down. You're paying more. You're no longer paying 96,000. You no longer get a yield of 3.5%. You're happy to get a yield of 1%. So in a recession, interest rates go down. And it's just, and you know, if you can pick, as I say, if you could pick what was going to happen, you'd be a rich person. If if you're interested, we haven't got time to look now. Oh, maybe we have. Let's have a look and see what US Treasury. What do we do here? Control click. Come on. Come on into that. Here we go. Treasury, daily yield curve. Yeah, backward Americans and their silly dates. 11, 12, 11, 13. So the 11 is November. 19th of November. Look at this. Yeah. The yield curve is still upward sloping. But look at the 1-year rate. Interest rates are very, very low in America. Aren't they? That's incredible. You invest in a 30-year government bond, you're going to get an annual yield of 3.8%, which is, what do you think inflation's going to be in America over the next 30 years? I don't know if 3.8% a year is enough to... So that's saying, I suppose, that people think the economic downturn is going to last for a long time in America. I don't think it's going to. Oh, I'm hoping it's not. I've just shifted a fair chunk of my superannuation into American equities. I'm hoping that they'll bounce back. This is one thing, one thing you can do with your retirement fund, you see. If you haven't got the choice, you have investment choice with retirement savings. So you can gamble on the stock market with your future. And if you gamble correctly, you get to retire earlier. And if you gamble incorrectly, then, well, I guess you just keep working. Whereas if you were to look at Australian rates, look at the Reserve Bank, go to interest rates. Interest rates and yields, money market, government bonds, Commonwealth bonds. Let's look at Commonwealth bonds, government bonds, monthly. So it's a spreadsheet. Might not open because it's enormous. It's downloading it. We'll let it download. Oh, here we go. Australian government 10-year bonds. Not that much. What was the American one? For 10 years. And the Australian one for 10 years is about the same. But the short-term rate, Australian for 2 years or 3 years, is around about the 3% mark. probably get the 1 year on a different spreadsheet, probably on the daily stuff. They should have 1 year, but there's no column A. And since the July, August, September, October, interest rates have been, the 1 year rate has been creeping up. That's been creeping up. That's been creeping up. And that hasn't. Whereas the American yield, 10 years, no, 10 years is still 2.71. 10 years on Australia, 1% more, 2% more at the low end. 2 years, 0.29. So 2.5% more for a short-term investment. So would you rather invest in America, American bonds, or Australian bonds? Well, Australian bonds are paying a higher rate of interest, but what's the risk? If you buy Australian bonds, you'll get a higher rate of interest, but the currency might not do as well. Because you've got to take into account the exchange rate. Why don't I borrow in America at 1% and invest in Australia at 3% and become very, very, very rich? The answer is I'd be borrowing American dollars and investing in Australian dollars. And when I go to repay the American dollars with my Australian dollars, maybe they won't buy me as many American dollars. So there's exchange rate risk involved. And that's another thing where we could learn about in an international course. Okay, we talked about zero coupon bonds. Let's take a 10-minute break and then come back and talk about coupon bonds. Did the roll get around the room? Yep. Thank you. Okie doke. Let's continue. We ready? Okay. We press on. Okay, so its bonds might be zero coupon, but it's more common for them to have a coupon. Coupon bonds pay the face value at maturity and pay the regular coupon or interest payments, right? Why would you rather buy a zero coupon or a coupon bond? Coupon. Why would you rather buy a coupon? Yeah, you get the interest. So if they're going to default in 10 years' time, at least you'll get the first 9 years' worth of interest. So it's only, so there's a risk element. If it was a government bond, I might be happy with zero coupon. But if it's a corporation, I might be worried about them still being there in 5 years' time, so I might prefer there to be a coupon payment. So it's a risk thing, and it's as much to do with agency costs as anything else. And yet again, the price is the present value of the future cash flows. The coupon payments form an annuity, use the annuity formula, and the future or face value comes at time n. And the yield to maturity is the discount rate that equates the price and the cash flows, because the coupon payment is known, the face value is known. So if we know Y, we can calculate P, and N is known, that's the term. So if we know Y, we can calculate P, or alternatively, if we know P, we can calculate Y, can't we? Because it would be an equation with one unknown in it. Let's say the US Treasury has just issued a 5-year $1,000 bond, 5% coupon. Always read carefully whether they're annual or semi-annual. It says semi-annual coupons. If it didn't say semi-annual, I think you'd have to assume annual, because that would be the default. But here they're semi-annual coupons. So 5%, the coupon payment is, it's an APR, 5% of $1,000 is $50. It's paid semi-annually, so it's $50 divided by 2, $25 every 6 months. So if every 6 months, and it's a 5-year bond, there are 10 periods. For the first 9 periods, you'll get the $25 paid into your bank account, and at period 10, you'll get the $25 final interest payment plus the $1,000 future value or face value. That's if you hold it to maturity. If you sold it at this point in time, then you'd get whatever the bond was worth at that point in time, and somebody else who you sold it to would get the future payments. So we know the cash values, we know the cash flows, which is the face value and the coupon, and we know the term to maturity. So if we know the yield, we can calculate the price, and alternatively, if we knew the price, we could calculate the yield. So what the financial press does every day is look at the most recent price and calculate the yield, and that's where those yields that we looked at a moment ago for Australian and American government bonds, those yields were calculated by looking at the most recent selling price. We knew the cash flows, so we could infer the yield. But if we wanted to value it from first principles, we could say at a certain yield, these cash flows are worth something. So consider the following semi-annual bond. We've got a $1,000 face value. 7 years until maturity, 9% coupon rate. It's a semi-annual bond, 9% coupon rate. So what's the coupon payment? 0.5? How many dollars is the coupon payment? The coupon payment is the rate times the face value. So that's what's 9% of 1,000? 90. It's semi-annual. Divide by 2. 90 divided by 2 is 45. So the coupon payment is 45. 7 years until maturity. So what's N? 14, because it's a semi-annual bond. N is 14. The price is 1080.55. Solve for yield. How would we solve for yield? There's an equation. There's only one unknown in it, which is y. Do you know how to do that? So how would you do that? Logs? Yeah. But we don't need to. We can use the annuity calculator. All right? So we can be quicker. We could use the yield. We could use the annuity calculator. So just looking at the yield to maturity for the moment, the face value is $1,000. The payment is $45. The number of periods you said was 14. The present value is 1080.55. Solve for yield. And the rate, so you could use the annuity calculator or your financial calculator, or presumably you can do that on the graphics and solve it. So what's the rate come out? Somebody solve that. What's y? So I'd do this on a computer, I'd use the annuity calculator, or I'd do it on a spreadsheet. Which means I wouldn't ask you to do it in an exam because we've got different calculators. But you do need to do it for homework, you do need to do it for Connect. And you need to understand what's going on. Somebody, come on. You need to have a decent calculator, you can do it. So solve that equation for y. Quite a hard equation to solve, isn't it? Okay, so the number of periods is 14. The rate is what we don't know. Present value is negative 1080.55. Payments are 45. And the future value is $1,000. 3.75%. Solve for Y, 3.75. So, a very simple question, calculation using the annuity calculator. Solve for Y, 3.75%. So this would be 3.75%. Suppose the yield increases to 10% APR. So if the yield increases, the price will change. The yield increases to 10% APR. What's Y? %10 APR, and we want the rate for every 6 months, so that's 5%. So if we make Y 0.05, we can solve for P. So using the annuity calculator, the rate has gone up to 5%. Now we want to know what the present value is. Well, if the rate goes up to 5%, the present value becomes $951. Huh? So these sort of calculations are pretty easy if you've got the right calculator. They're a bit longer if you haven't got the right calculator. At the time of issuing this bond, 9% was the rate. Is the bond selling at a premium or a discount? Premium. It's $1,000 it's selling for. Why is it selling at a premium? Because it's paying 9%, but the required yield we could work out is 3.75%. So the appropriate opportunity cost of capital is 3.75% per 6 months. This is paying 4.5%. It's valuable, it's selling at a premium. Interest rates go up. What happens to the value of the bond? No, interest rates go up, but the coupon payment doesn't go up because the coupon payment's fixed. So if the interest rates go up, looking at this equation, if you make Y bigger, what do you do to P? It goes down. Present value of your future cash flows is less. And in this case, it was 900 and whatever I said it was. Right? So price is not the same thing as face value. Price is the present value of the future cash flows. Face value is what it was set at when it was issued. And it sells at a premium if it's more than face value. It sells at par if price is equal to face value. And it sells at a discount if the price is less than face value. And why does this happen? Well, interest rates change. If interest rates stayed at 4.5% per 6 months, the bond would sell at $1,000. Interest rates drop to 3.75, the price goes up to 1080. Interest rates go up to 5%, the price drops to 960 or whatever it was. Right? So an increase in the required yield decreases the present value of the cash flows and then hence we trade at a discount. And if a bond trades at a discount, do you want to buy bonds that are trading at a discount? Well, if you do, you'll get the coupon payments, which are small, but you'll make a capital gain at the life of the bond, at the end of the bond. Whereas if it's selling at a premium, so if a bond trades at a discount, yield to maturity exceeds coupon rate. That's probably the wrong way round. If the yield to maturity exceeds the coupon rate, then the bond will trade at a discount. So which comes first? You know, it's the sort of chicken and the egg. If interest rates go up, then bond prices go down. And vice versa. So that's an increase in the yield to maturity, decreases the present value of the cash flows. A decrease in yield to maturity increases the present value of the cash flows. And that's how you get a premium. If you buy a bond for a premium, you're paying $10.80. Which means you're going to lose $80 because the future value is only $1,000, you're paying $10.80. On the other hand, you're going to get bigger coupon payments. So if the bond trades at a premium, coupon exceeds yield to maturity. Or if another way of looking at it is, if the coupon rate is less than coupon rate, if the yield to maturity is less than the coupon rate, then it's a good bond to own and it will sell at a premium. I mean, most bonds usually trade at very close to par when they're issued, but then as interest rates change, bond over the life of this, over the life of this 7-year bond, prices are going up and down, interest rates are going up and down, prices are going up and down. And if you can buy high, or buy low and sell high, you'll make money. There's a little table that summarizes what we said. If the coupon rate is great, if the actual payments are greater than the required yield, then it trades at a premium. If they're less than the face value, it trades at a discount. Look at an example of that. Let's have 3 30-year bonds issued by the same government, so the risk is the same. One bond has 10% coupon, one has 5% coupon, and one has 3% coupon. But the required yield for all of them is the same because they're the same risk, and that's 5%. Well, what do all these different bonds trade at? Take this formula, price, yield is 5%, coupon varies, and face value is the same. The 10% coupon bond has 30 payments. Is it 15 years? These are annual coupon payments, 30-year life. So 30 payments of 10, or 30 payments of 5, or 30 payments of 3. Get the face value back in year 30 anyway, and the required yield is 5%. So if the required yield is 5% and you're getting a $10 coupon rate, then go to trade at a premium because you're getting $10 rather than 5. If you're getting the $5 that you ought to be getting at a yield of 5%, it'll trade at par. And if you're getting if you're getting only $3, then the interest payments are pretty low and it'll trade at a discount. Now, your textbook has this annoying thing called a current yield. So you need to be all three bonds here have got a 5% yield to maturity, right? But they've all got a different current yield because the current yield is the annual coupon divided by the bond price. So for that 10% bond, it's 10 divided by the price, 5 divided by the price, or 3 divided by the price. What does that tell you? If you were to look at current yields, you might think this is the best. Is it the best? No. All three bonds are going to earn you on average 5% per year for 30 years. These current yields, which are quoted in the paper, are misleading, really. They don't measure the rate of return. Because in this case, the current yield of 5.65 is less than the coupon. It's overstating the return. Why? Because it's not taking into account the fact that you're going to suffer a capital loss. You're paying $176 for something that you're only going to get $100 back in 30 years. Where the current is equal to the coupon, that's fine. And the 3% bond, the current yield, which is this number, 4.33, is greater than the coupon. So because the thing is selling at a discount, you're going to make a capital gain, and that's not calculated as part of the current yield. So the current yield doesn't take into account capital gains or losses. So really all I want to say about that is that the current yield is a misleading term. And but why do people cite it? Why do they cite the current yield? Yet again, historically, it's easy to calculate the coupon divided by the price is what? Simple. It's just arithmetic, 10 divided by 176. To solve that equation for y, if you didn't have a sophisticated a graphics calculator or a financial calculator, you'd have to do logs and take 2 pages of working. So this running current yield is just a misleading term. But you've got to be very careful if you're working with current yield. Okay, well, we can work out here, these were prices for these bonds at a point in time. The point in time was 30 years to maturity. What happens to bond prices over time? Does the price of the bond always stay the same? Well, no. This bond here, paying these amounts, as you get closer to each payment, what happens to the present value of the cash flows? Would you rather get $45 next week or next year? Next week. So what happens to the value of the cash flows as you get closer to them? It increases. You'll pay more to get $45 next week than you will to get $45 next year. So bond prices are dynamic. they change over time. The closer you get to, because n changes, okay? Everything else can stay the same, but if n changes, then you're going to get closer and closer to something. Let's look at an example. So, holding all other things constant, the price of the bond will obviously move towards par over time. Because at maturity, what do you get back? The face value. So what's the present value going to be at maturity? It's going to be the face value, because that's what you get back. If in 10 seconds' time you're going to get $1,000, what's it worth to you? $1,000. It doesn't matter that 5 years ago it was selling at a premium or a discount. At this point in time, when I'm going to get $1,000 tomorrow, or in 10 seconds' time, I'm going to get $1,000 in 10 seconds' time. Okay. So consider we've got a 30-year bond, 10% coupon rate, $100 face value. Red, where'd the red pen go? Here we go. So we have a 30-year bond, 10% coupon rate, annual payments. So what's the coupon payment? 10. N is 30. Face value is 100. Y, the yield to maturity, is 0.05. So value the bond, well, we've already done that. That was this example here, wasn't it? This one. 176.86. What will the price immediately before and after the first coupon? So, 176.86, we can do that. Now consider the cash flows in 1 year's time. Immediately before the first coupon is paid. Huh? So this is what we're doing. Now we're moving the annuity around in time. It's a year from now. A year from now, you're going to get $10 immediately. Then you're going to get $10 per period for 29 periods. And you're going to get that $100 face value in 29 periods' time. So the price, just before the first coupon, is $185.71. If you bought it for $176.86 and sold it for $185.71, what rate of return will you have earned? You can either know what you're doing, or take that, divide by that, minus 1. So 185.71 divided by 176.86 gives you a return of how much? 5%. Well, you knew it was going to be 5% because that's the yield to maturity. The whole point about this investment is you're going to earn 5% per annum. That's why the yield to maturity is 5%. So it starts the beginning of the year at 176.86 and it goes up 5%. to 185.71. If you hold it for a year, you'll earn 5%. What happens after? What's going to happen to the price after the next coupon payment? No, it's now times 0, and we're going to get $10 in 10 seconds' time. Go forward in time a minute. We're no longer going to get that $10. We already got it, or somebody else got it. So what's the value of the bond at this point? At that point in time, less. How much less? $10 less. It's going to price of the bond will fall by the coupon payment. So just after the first coupon, we've got a $29 annuity of $10 and $100 in 29 periods time. $175.71, which is of course $10 less than $185.71. Huh? So the bond price, you think of the bond price goes up during the year because it's going up at a compound rate of 5%, and then it drops because of the coupon payment, because that cash flow disappears. Then it goes up again and drops. It goes up again and drops. So over time, we get this sawtooth pattern. The value of the bond increases, earns 5%, drops, earns 5%, drops, earns 5%, drops, earns 5%, drops, blah, 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 and eventually gets back to $100. The 3% coupon rate earns 5%, drops, earns 5%, drops, and eventually the price gets back to $100, as does the 5% coupon rate. Huh? So the price of the bond changes over time. You're just going to earn a 5% return. But the price of the bond is changing. That's if this is the effective time on bond prices if the yield doesn't change. Huh? If the yield changes, well then it could go up or down. It's still going to head towards $100 in the long run, but it could be all over the place. As yield changes, it goes up, it goes down, it goes round about, ends up back at $100. So what we've seen is that there's an inverse relationship between interest rates and bond prices, haven't we? As interest rates rise, bond prices fall. As interest rates fall, bond prices rise. This is known as interest rate risk. You're facing interest rate risk. If you're an investor, and you buy the bonds, you're hoping the price will rise. You don't want it to fall. If you're a bank or a government and you're issuing the bonds, you'd like the price to fall so you can buy them back at a cheaper rate. You don't want them to rise because it's going to cost you more money to buy them back. Huh? This is the sensitivity of a bond's price to change in interest rates is called duration. I'll come back to this point in a moment. Look at this example. We have a 15-year zero coupon bond and a 30-year coupon bond 10% annual coupon. Now, which do you think, if interest rates change, which of those do you think is going to have the biggest change in price? Well, you would think the 30-year would. That's logical because it's longer to maturity. So if if the cash flow is due tomorrow and interest rate change has little impact. If it's cash flows coming in 30 years and interest rate change, it could have a big impact. But let's see what happens here if it changes from 5 to 6%. So the zero coupon bond at 5% and at 6%. So that's when interest rates rise, the bond falls, and it falls 13.2%. The 10% annual coupon bond, we've seen that before, at 5% it's 176, at 6% it's 155. So the price falls 12.3. So the 15-year bond actually had a bigger change in price, which is not what you expected. Why is that? It's because of the coupon payments. So this doesn't pay anything until year 15. This doesn't pay 100 face value until year 30, but it does pay $10 in year 1, year 2, year 3. So looking at somehow taking both into account, if there was 2 zero coupon bonds, the biggest price change would be for the 30-year one. But duration is related to both coupon rate and maturity date. Because sensitivity to changes in interest rates is measured by this concept of duration. High durations, high maturity, are very sensitive to interest rate changes. Low durations are less sensitive. But the point being here that duration is not simply maturity, it's also related to coupon. And how one could use the concept of duration, how one can calculate accurate duration, how one can maturity match one's assets and liabilities, and how one can use interest futures contracts to hedge against that interest rate risk. If you're a bank or something, is yet again, it's not something for this course. The main point for this course is to realise that as interest rates change, values change. And the amount of the change depends upon both the coupon payment, the $10, and the face value. I think I'm going to leave it at there for this week. I've only got about another 15 minutes on this topic to bring into account risk, and we can do that on Monday.